Greetings to all the learners of Dr. B.R. Ambedkar Open University. In today's session, we will be concentrating on material costing, which is an important element in cost accounting and control. In today's session, we will discuss what is the meaning of material costing, what do you understand by material control, how is inventory valued, and how are material which is issued to the departments priced. So, these things we will talk about in today's discussion. Usually what happens is when you talk about cost has got various classifications to it. We have cost which is in the form of direct and indirect, those which are utilized, cost which are incurred in order to produce the goods, in order to convert raw material into finished product. So, therefore, in today's discussion we will talk about what is the meaning of material costing, how are material classified, what all goes into costing of material, how do you exercise control over the issue of material, how does the company procure material, what are the documents which are involved in material accounting, how is inventory valued, that is the stock which is there with the company, how does the valuation of that stock take place, and when this material is issued to the production department for the purpose of production, how is this particular material being priced. So, these things we will talk about in today's session. Let us begin with understanding what do you mean by material cost. In cost accounting, material costing refers to the process of determining the cost of material which is used in the production. You have various elements of cost such as material, labor and overheads. When you talk about material basically is nothing but raw material which is in the form of which is actually being used in order to produce your finished products. So, therefore, this raw material is nothing but stock and or inventory, and when this stock or inventory is utilized by the company in order to produce finished products, we basically call it as material costing. So, in material costing, we are talking about the process of determining the cost of the material which is used in the production process. What actually happens here is the company has various departments. You have a department which is called as a stores department, you have a department which is purchase department, then there is production department, then there is sales and marketing department. The role of each one of these departments is defined in terms of how material is being utilized in their departments. For example, in the stores department, the department's function is basically storage of raw material. So, whenever finished goods are produced in the company, the raw material which is to be used in the process of making the finished goods, that raw material is stored in the stores, and from the stores the raw material is issued to the production department. So, that production department undertakes the production of the finished product. So, therefore, whenever there is a need for the production department in terms of raw material, they will put up a requisition to the stores department saying that or stating that we need such and such type of raw material for the purpose of production. So, stores department will issue this raw material to the production department, which will convert the raw material into the finished product. Once the finished product is being made, it is now the duty of the sales and marketing department to take that finished product to the market and give it to the customer, sell it to the customer. And here, whenever the raw material is getting out of stock, the stores department basically informs the purchase department for replenishment, that is nothing but repurchase of the inventory. So, purchase department's role will be to purchase the raw material from the vendors or the suppliers. So, all these departments are in one way or the other connected with the material. So, in material costing, we are talking about all the stages which are involved in acquisition, storage, usage of the material and also assigning the cost of all this material to the specific products or the jobs. So, purchase department acquires the material, stores department stores it, production department uses it to convert into finished goods, and therefore, at each of these stages costs are being incurred. So, when all these costs are ascertained, the total cost is nothing but the material cost which is there into consideration. So, this particular process of material costing, it will help a business to understand the cost of their inputs, it will help them to manage their inventory, and it will also help them to make an informed pricing decision related to how the material is issued to the production department and also how pricing has to be done related to their finished product. So, therefore, material costing becomes very essential. Now, when we talk about material, material can be classified into various types. The broad classification talks about direct and indirect material. Whenever we use the word direct material, it means that all those raw material or the stock whose traceability is directly with the finished outcome. For example, we are talking about manufacturing a biscuit. In manufacturing a biscuit, if I am using wheat flour and sugar, then these two products directly go into manufacturing of the biscuit. They are a part of the finished product. So, then when I am purchasing sugar and wheat flour, these two become my direct material. On the other hand, indirect material will be all those consumables which do not enter into the finished product directly. For example, the machine on which I am manufacturing this biscuit, if that machine requires oil, lubricants or grease, then those will become indirect material. They are consumables. They do not enter into the finished product, but they are essentially required for production purpose. So, therefore, the broad classification is direct and indirect material. Apart from that, if you see the classification of the material, we also talk about raw material. Raw material is the crude material or the raw form of any stock or inventory which is used for the production purpose. When we talk about constructing a house, we talk about cement or bricks. All these go as a part of your raw material. If you talk about, for example, assembling a laptop or a computer system, then the motherboard and all the chips which are being used there will be the raw material to make the finished product. Then we have components. Components are finished parts which are made out of the raw material which are actually assembled to make the finished product. Like I said, if you are manufacturing a car, then all the components which are required to manufacture a car, such as wheels of a car or seating or the leather or the interiors whichever we use inside the car, all those will become the components. So, therefore, they all make up the finished product, the car. Again, you have a classification in the form of tools. Tools are nothing but all those appliances which are used in manufacturing operation. So, near the machines which engage into production process, all those equipments which I am using for the purpose of manufacturing, they are all called as tools. Then the machine also requires certain spare parts like nuts, bolts or spares. All these things are also essentially called as material only. Then you have consumables like, as I said, oil, grease, lubricants or cotton waste, anything which you are using near the machine so that the machine is running in a good condition and the machine consumes all these material in order to produce. So, these are also a part of your raw material. So, raw material classification here goes as raw material, actual material which is used for producing the finished product, components, tools, spare parts and consumable stores. All this together will be called as your material. Then, as I said, material is classified as direct and indirect based on their traceability. If you are able to trace out that the material is becoming a part of your finished product, then it is called as a direct material. If the material is not becoming a part of the finished product, but it is used in order to make the finished product, then it is called as an indirect material. In direct material, again you have primary and basic raw material. Primary material, for example, we talk about consuming things like ghee or oil, where we are using the tins or plastics which are used for packing these things. They become your primary raw material. Or in a construction industry, we talk about cement bags. So, the cement is actually put inside a bag. So, that bag becomes my primary raw material. Then basic raw materials can be, for example, we are using gold and silver in manufacturing jewelry or paper in the manufacturing of books, or we talk about milk and creams which are used in making ice cream. All these things will become a part of our basic raw material. So, therefore, you have direct material. Then you have indirect material, where material can be also very insignificant in the entire process of manufacturing. For example, in a big company which is manufacturing clothes, we use thread for stitching. So, that particular thread actually is essential to stitch the cloth, but the value of it is insignificant. So, therefore, such material will be called as your indirect material which will be there. On the other hand, you also have material which are used by the service departments. For example, you talk about a boiler house or a powerhouse where you have maintenance equipments which are being used. They also will be called as your material. So, this way also we can have direct and indirect material classification. Now, whenever we talk about how this material costs are determined, whenever the company is purchasing material from a vendor, the material is priced at a particular value. So, how is this costing being done? So, material cost will basically include cost of all the raw material, cost of all the components, includes also cost of transportation, handling, insurance, storage. All these costs put together will be becoming your material cost. So, material cost will be whatever you have paid to the vendor to get the material, plus all the transportation costs which you have incurred to get the material to your premises, insurance if any, handling charges, storage charges, all put together will be called as your material cost. Now, once this particular material is with the company, they also have to see to it that there is no wastage of this material. So, they have to put the material to the best use. So, therefore, there is minimization of wastage or spoilage or making the material obsolete. So, all these things have to be avoided in a company so that material cost is being controlled. So, this also involves implementation processes at procurement stage, storage stage and usage stage which is there. Then when we talk about material which is moving within the company, now the company has acquired from the supplier. Now, the company will store in the stores department. From the stores department, the material has to move to the production floor. So, when it is moving, the stores department will also do pricing of the material. How many units are going, what is the value of that particular unit which is moving. For example, stores department may have some 1000 or 10,000 quintals of wheat flour with them if the company is manufacturing biscuits. Then out of those 10,000 quintals of or tons of wheat flour that I have, how much am I releasing to the production department? Maybe on one fine day I am releasing only 100 tons. So, what is the value of that 100 tons? The stores department will price this material issue which is there. So, this is called as your material valuation. So, here we talk about various methods which are there in material valuation. You have methods such as FIFO, which is called first in first out, or we also call LIFO, which is last in first out, or average methods where we talk about simple average and weighted average. This we will have a detailed discussion further in this session. Then you also have inventory management where we talk about how the inventory is being controlled using various techniques of inventory control which is there. So, here we are talking now about material pricing and material control. So, when we come to procuring material, before pricing is being done, first of all we have to get the material from the supplier. So, whenever we are getting the material from the supplier, we have to ensure that we are taking it from the trustworthy supplier. Credibility of the material is also there, and at the same time the material is purchased at a reasonable price. So, therefore, every time the company needs material to be purchased from the supplier, the stores department will put up a requisition order. So, on the screen you can see that there is a purchase requisition form. That form is being filled by the stores department and it is being sent to the purchase department so that the purchase department purchases the same from the supplier depending on whatever is the need. Production department will inform the stores that so and so material is needed, and stores department, if it has the material, they will release it. If they do not have the material, they will request the purchase department to purchase that particular material. So, whenever the material is getting purchased from the supplier, we call it as material procurement, and this procurement is done through purchase requisition form which is being filled and given. Now, here we have purchase requisition. Then we have selection of supplier. If the company has already been purchasing from supplier since many years, they can continue to do so from the same supplier. Sometimes the company changes the supplier, then they have to search for these vendors or suppliers. Sometimes the company is altogether new, then they call for tenders, and through those tenders they will select the suppliers who are there. Once the supplier is selected, then they go for purchase order, they place the purchase order and they follow up from the supplier. The supplier supplies the material and the company receives it. Once they receive it, the stores department will take up inspection and testing, whether the material received is in order or not, whether it is as per the purchase requisition which was being given or not. In case there are any material which are obsolete, spoilt or anything, they are returned back to the supplier, and in case the material is fit and fine, they pass the invoice and make the payment to the supplier. Then you have documentation which is involved in the material accounting. In stores department, we have a record which is called as a stores ledger. In stores ledger, we have a separate folio where individual item of the stock is being maintained. So, within the stores department, for example, my company might be manufacturing multiple items. So, in my stores, I can be having different types of material. So, therefore, here for every material, then I will have something called as a numbering or a folio which is being maintained for individual item of the stock. So, this you call as a stores ledger. Or sometimes the company can also maintain something called as a bin card. Bin card will be something where you will place the products in bins or racks or shelves, and near the each shelf or near the each bin you will place a tag or an attachment, and on that attachment or a tag you will mention the details of all the material which is stored in that particular rack or in that particular bin. So, therefore, it is called as a bin card. For example, if the company is manufacturing chocolate, then you have got cocoa, sugar powder, milk, cream, all these items are there. All this cannot be stored together as such. So, you will have to store in different racks or different bins. So, wherever I am storing cocoa, wherever I am storing sugar, wherever I am storing cream or any other preservative, then I will tag it and mention the quantity of that particular material there. That is called as your bin card which is there. Then sometimes it so happens that when the production department receives this material, the material may not be of a good quality. So, they may not be suitable for production. So, they will return the material to the stores department with a note, that is called as a material return note. Why are they returning the material? Sometimes it so also happens that there may be different production departments, production department A, B or C, and stores department may release the products to A. From A, the product may be transferred to B or C. So, then A will issue a transfer note saying that so and so material has been transferred from our department to another department which is also engaged in the production process. So, they will issue a material transfer note. That is also a document which is used in material costing. Then you have a stores requisition note. As I said, whenever the production department is feeling that or seeing that there is a lag in the production items, or they need some production items which are or raw material which is needed for production, then they will put up a request to the stores department asking them to release the material. That request is nothing but your stores requisition note, whichever production department gives to the stores department. Then the production department, once they receive the goods from the stores, they also have something called as a goods received note, and also stores department will also give a goods received note to the supplier or the purchase department. Whenever the purchase department gets the material from this vendor, they will send the material to the stores. So, stores department will do inspection and checking, and then they will issue a goods received note saying that so whatever purchase department sent to us, we have inspected and we have received those particular goods. So, this is called as a goods received note which is sent to the purchase department from the stores department. These are all the documents which are involved in the material costing. Now, let us come to how these material is priced. Now, whenever the stores department is sending material from their department to the production floor, they do not send just like that, but there is a pricing which is being done to this material, though the price is not paid out of the pocket, but pricing has to be done so as to know how much is the value of the material which is being used. So, you have different methods of pricing of material issue, which is also called as material costing methods or pricing of material issue. The first one here is called as first in first out method, then you have last in first out and average costing method. Let us discuss each one by one. First in first out method. In this method, what happens is, say for example, in the month of January, if I am purchasing material from January 1st to January 5th, 5 days I have purchased material. 6th and 7th I have issued the material to the production department. So in the stores department, I am being consistently receiving material from Jan 1st to 2nd, 3rd, 4th and 5th. 5 days I have received the material. 6th and 7th day I have released the material to the production department. Now which material will you release? Will you release the one which you received on Jan 1st or 2nd or 3rd, 4th or 5th? So in the method of FIFO, what happens is the word says first in, first out, which means whatever you received first will go out first. So material which the company received on Jan 1st, that will be released to the production department first. Then if the production department needs more, then they will release from the next lot which was received on Jan 2nd. Then the third lot which was received on the next day and next day. So like that, whatever material came first, that goes out first. That is called as your first in, first out. So valuation or pricing of this material is done based on, for example, from the vendor on January 1st, I purchased 100 units at 10 rupees. January 2nd, I purchased 80 units at 12 rupees. Now on 3rd, production department is requiring 120 units. So when they require 120 units, on Jan 1st, I received 100 units at 10 rupees. So I will release 100 at 10. What is the shortfall now? 20 units, because I need how much? 120. So 100 is released at 10 rupees. Remaining 20 will be released from the lot of 80 units. That 80 units was priced at 12 rupees. So this remaining 20 which I require now, 100 into 10 I will price, 20 into 12. So remaining balance what I will have is, first what came? 100 came, that got exhausted. Next lot was 80, out of 80 I released 20. So what is left now? 60 is left now. So that will be the balance which will remain in the store. So if I am following such a method, this method is called as a FIFO method, which is called first in, first out. The opposite of this method is your LIFO method, that is last in, first out. Whatever comes on the last of the last time or the last day before the production department gives request, then whatever is in the stores on the last day, I will release that first. Then later I will come to whatever remains in the beginning days which are there. That is called last in, first out. As I said the same example, if I am purchasing from Jan 1st, 2nd, 3rd, 4th, 5th, 6th and 7th if I am releasing, then on 6th, first I will release material which is purchased on Jan 5th. Then I will release the one which is purchased on 4th, then on 3rd, then on 2nd and then on 1st. This is called last in, first out, which means whatever was bought recently, whatever was purchased last will be released out first to the production department. Then you have average method. In average method, what happens is we are not considering what came first or what came last, but we are considering whatever remains with the stores department. So at the end of the day, before the production department gives a request, whatever remains there, based on that I will do averaging and I will send. Say if at the end of the day I had some 1000 units with me, if production department are requiring 800 out of that, then those 800 I will release out of 1000. Whether I purchase those 1000, how many were coming in the first or in the last, I do not take into consideration. Total lot which is with me, I will release based on the total lot. This is called as your average method which is there. Let us see a problem there on inventory valuation. If you look on your screens, you have a company or you have a person who is a sole trader who is closing his books on 31st January every year. In 2007, there was stock taking which was completed and the value of the stock came to 1,46,000. Then there were certain transactions which took place in the books of account from 21st December to 31st December. 26th December he completed the books, but from 27th to 31st there were some transactions which took place. Based on that transaction, they want you to compute what is the value as on 31st December. Let us see what all happened. They purchased material worth 5,000. Sales were made out of the amount to the extent of 1800. Sales were also returned back from the customer to the extent of 250. Purchases which were made were also returned to the extent of 500. Then you had all those goods which were purchased. Some of them were actually not delivered. that is 1500 worth goods were not delivered. So all these entries happened between 27th to 31st. So let us see how we value inventory in the books of account, and in all this process the ratio related to profit is computed at 28% of the turnover. If you see the valuation of the stock as on 31st December, first we take into consideration, see whenever we talk about material consumed, we have a formula where we say opening plus purchases minus closing. That formula we used for material consumed, and when we talk about material or the value of the stock at the end, we take into consideration opening, purchases and whatever was consumed. Then whatever is left out is your closing. So here we talk about opening stock, that is as on 26th December, because we are taking only 4 days of transaction, 27, 28, 29, 30, 31st, those days of transaction. So here when we compute the value of the material, we take into consideration all these things. We have stock, we have purchases, then whatever goods are not received we have to deduct, sales returns also we have to deduct, and whatever we sold, adjusting the profit, then we get the valuation of the inventory. Similarly, if you see one more problem, we talk about how valuation is being done related to when you have expenses with you. So in this problem we have administrative expenses, we have inventory, we have purchases and we have closing stock which is given into consideration. If you see inventory valuation as on June 30th, we are saying that inventory is valued at rate of last consignment, which is whatever is the last consignment which you received, last order which you received, on that value you are valuing the inventory. Then as I said, material consumed, when we are saying, it is nothing but opening stock plus purchases minus closing stock. So if you see in this problem, your opening stock was 50,000 and then purchases you added because 2 times you made purchases, then closing stock you deducted, that was 1000 tons which was valued at last inventory. Then that way whatever are the expenses incurred, once we get cost of material, we also take into consideration the expenses and then we get the cost of goods sold. Similarly, we can also find out profit, because profit is nothing but sales minus cost of goods sold. This is your valuation of inventory. How is inventory valued? Similarly, as I said, FIFO, LIFO and weighted average method. If you look at this problem, you are given dates, date wise entries which have happened. You have Jan 1st opening stock, Jan 3rd issues, Jan 2nd receipts, Jan 4th again receipts, on 6th you have issued, on 7th you have received. So they are asking you to prepare a ledger account. If you prepare a stores ledger account, this format you follow, where the format has date, receipts, issues and balance. These are the 3 main components. In receipts column, you will have number of units received, at what rate and what was the amount. Similarly, in issues column also you will have units issued, at what rate and the total amount. Then balance column also same thing. What is the balance of units in the stores department? What is the valuation? That is rate and the amount. So date wise we will record. If you see Jan 1st, you will get opening stock. So directly I am taking to the balance column because it is neither issued nor received. Similarly, Jan 1st I have issued 40 units. Sorry, Jan 2nd I have received 120 units. So 120 units are received at 11 rupees. So I am writing 120 in the units column, 11 in the rate column. Multiplying these two, I get the amount 1320. Then on Jan 3rd, there is some issues which happened. So I will directly go to the issues column and say how much is issued. If I am following FIFO method, what came first? First came 100 units were already with you, which was balance. So first I will issue out of 100. So 100 was valued at 10 rupees. So now I will issue 40 units at 10 rupees. Then I will issue from the next lot which is remaining with me. From the next lot I will issue. Similarly, there was also a loss there. So that loss also is taken into consideration. So this format if you follow, where you are issuing from whatever you received first, that is called as your FIFO method. Similarly, let us see LIFO method with the same problem. You have the format remains same for the stores ledger. You have date, you have a column on receipts, column on issues and column on balance. So date column will record all the dates. Receipt column will record units, rate and amount. Issues column also will record units, rate and amount, and then balance column also will record the same. Here simply to understand that whatever was received last will be issued first. So if you see in the issues column, 50 units are issued at 11 rupees. In the previous one we issued 40 units at 10 and 10 units at 11. But here we are issuing 50 at 11 rupees only because that was received last. This is called LIFO method. Then you have weighted average method, simple average method, where I am only doing averaging. If you look at the columns of issue, I am adding 2 plus 2.4 divided by 2. So that 2 plus 2.4 is nothing but rate at which the units are valued. So it is a weighted average method where I am doing averaging of the price. Price is taken as a base there, and prices of last two receipts are added, and then issues are being determined which are there. If I do weighted average, in weighted average I am multiplying units with the price and then determining the weight. So unit and price together I will take average and then determine. So that way you have material costing which is taken into consideration. So here in this entire session, what you would need to remember is, first of all, what is the meaning of material cost? Secondly, what are the various elements of material costing, because in material costing you have procurement, you have issues, that is pricing, and then you have got documents which are very essential to maintain in the entire production department, stores department, purchase department. And whenever the material is issued from stores to production or from purchase, whenever they are sending requests to the stores department, you have formats which you have to follow. There are stores ledger and the bin cards, and these formats are used, and material is priced either at FIFO, LIFO, simple average or weighted average methods which are there. So in this session we have completed about material costing, where we have spoken about pricing of material issues. Thank you.